Breaking news this morning, Amazon has just announced it's cutting 16,000 jobs worldwide.
Jack Dorsey's financial tech company Block says it will cut 40% of its workforce, affecting over 4,000 jobs as it moves more artificial intelligence throughout their organization.
In early 2026, over 780 tech workers are being laid off every single day. That's more than 40,000 people in just the first 8 weeks of the year. That's one person losing their job every 2 minutes.
So yesterday I was laid off.
Just got laid off.
Just got let go from my job. I wasn't expecting that this morning, so I'll be fine. I worked for Midday Squares in marketing. They had to let go of the marketing division, which is fine. It just came as a bit of a shock. I'm a strong believer that everything happens for a reason.
Guess who got laid off from their job today? Yes, me. You guessed right. And I'm only smiling because I'm trying to stop from having a full-on mental break. I literally just started this job last month. Can you believe it?
If you're in tech right now, you've felt this. The constant anxiety, the refresh of LinkedIn seeing another sea of open to work banners. Maybe you've been laid off. Maybe your friends have. Or maybe you're just wondering if your calendar is next. Everyone keeps saying it's because AI is simply replacing us. But when you look beyond the fear-mongering, that's not the full story.
Many companies are cutting costs by trimming middle management and, in certain industries, eliminating entry-level roles that can be replaced by AI. But layoffs aren't the only thing experts are concerned about. Generative AI is speeding up how people work, but that efficiency can come at the trade-off of maintaining skills and rising up the corporate ladder.
The real story is much more calculated, and honestly, it's brutal. A few years ago, engineers were getting 5-figure sign-on bonuses just for showing up. Now, senior architects who built the systems running half the internet are getting rejection after rejection, with overall tech rejection rates up by 30% to 40%. And here's what's weird. At the same time, companies are laying off thousands of engineers. They are also hiring, just different people with a totally new AI-first skill set. These same firms are spending more money than ever before in history, not on people, but on AI infrastructure that costs billions to run every single month, with the top 4 hyperscalers alone budgeting $700 billion for 2026.
Globally, nearly 40% of workers' core skills will be disrupted by 2030 due to AI and digitalization. It may be difficult for newer employees to build the skills they need due to organizational flattening.
This data point is critical because it implies that 4 out of every 10 jobs worldwide will see their core tasks significantly altered, shifting the bargaining power away from human labor and toward the owners of the software. Goldman Sachs goes further, estimating that up to 300 million full-time jobs globally could be displaced by automation technologies. This massive figure represents more than the entire population of most G7 nations, signaling a structural change rather than a temporary economic cycle. Data from the World Economic Forum, suggesting that while millions of roles would shift, the net result would be a more robust global middle class. This implied that for every job lost to a machine, more than one higher value role would be created in its wake. This compensation theory of economics held that technology-driven wealth would always trickle down into new forms of labor demand. However, as we move through 2026, the reality on the ground has diverged sharply from that promise. We are witnessing a phenomenon where companies are reporting record-breaking efficiency and digital margins at the exact same moment they are announcing the departure of thousands of experienced professionals.
There's also a problem for companies. 63% of employers surveyed expect skills gaps in the labor market to hinder organizational transformation. 42% of employers expect talent availability to decline between 2025 and 2030. Bean says companies must re-engineer workflows that include advanced technology, but also allow novices to participate.
In the 1980s, managing a database required a full team. Today, it requires one person and an API. This shift is a cold mathematical optimization. Management is heavily incentivized to prioritize operating margins because Wall Street consistently assigns higher valuations to companies with high revenue per employee ratios. Consequently, when technology allows for the automation of predictable cognitive tasks, entry-level roles are the first to be removed to inflate the stock price. This trend is supported by data from the OECD on the rising automation of task-based labor in professional services. The cost of this shift is not just found in a severance check. It is found in the erosion of the human pipeline. When a company eliminates junior analysts or entry-level programmers in favor of AI-assisted seniors, they are effectively eating their seed corn. They are gaining short-term margin at the expense of long-term institutional knowledge. If there are no juniors today, there will be no seniors in 10 years. The cost is a workforce that is becoming bifurcated, a small group of highly paid automation architects at the top and a growing sea of precarious gig workers at the bottom.
The challenge is if everyone takes that mindset of, I can't guarantee these folks are going to stick around and be my mid-level talent, I'm just going to save a buck today. If everyone does that, the entire pipeline of talent starts to collapse. And in a few years, employers in lots of sectors are going to find themselves in trouble.
There is also a profound psychological cost. The American Psychological Association consistently reports that work and economic stress are leading drivers of anxiety for over 70% of the population. When workers believe they are replaceable by a prompt, loyalty declines and risk-taking drops. People stop buying homes, they stop starting families, and they stop investing in their own education because the return on investment for human skill is no longer clear. The Federal Reserve and the Bureau of Economic Analysis report that personal consumption expenditures account for approximately 2/3 of U.S. GDP. If workers earn less or feel insecure, they spend less. This creates a ripple effect where the very efficiency companies chase. This is the Henry Ford paradox in reverse. Ford paid his workers enough to buy his cars. Modern tech firms are cutting workers so they can no longer afford the services the AI is providing. Report from Columbia Law Review have documented the rise of ghost jobs, postings that companies never intend to fill but keep active to signal growth to investors. Research shows that as of 2025, nearly 20% of all job listings are ghosts, designed to harvest data rather than hire people. This deceptive practice masks the true cost, a generation of talent that is being sidelined while their skills are still at their peak. The quiet truth of 2026 is that we are not living through a tech problem, but a systemic choice. AI did not wake up one morning and decide to fire 160,000 people. AI is a tool of optimization, and it is currently being used to optimize for a single variable, the decoupling of productivity from labor.
The whole world has this huge inventive opportunity to say, okay, this thing currently, if you use it in default ways, is going to separate and weaken this bond between experts and novices in the work. Is there a way that it could make those things healthier? I think the answer is absolutely yes.
For the first time in human history, we have found a way to grow the economy without growing the number of people participating in it. Historically, when we automated the farm, we moved to the factory. But now we are automating the office. The U.S. Bureau of Labor Statistics confirmed in early 2026 that non-farm productivity surged by 4.9% in late 2025, while total hours worked barely moved. This means companies are producing significantly more with fewer human hours. The International Monetary Fund, IMF, published a 2025 white paper warning that AI is likely to substantially increase wealth inequality. Because AI allows firms to replace high-wage tasks with capital, software, the gains move from the payroll column to the net profit column, benefiting only those who own the infrastructure. We are witnessing the final stage of a decades-long trend. The machines didn't revolt. They didn't have to. They simply did what they were built to do. They made the process more efficient. And in a world where efficiency is the only metric that matters, the human element isn't an asset to be nurtured. It is a cost to be managed. Until the metric of success changes from revenue per employee to something that values social stability, 2026 will not be an outlier. It will be the new baseline. The system is working exactly as intended. The question is no longer how the machines work. The question is who the system is actually for. If the goal of an economy is to serve the people within it, we are currently failing. If the goal is to optimize a spreadsheet, we have never been more successful.